Welcome to this deep dive. Today we are putting on our Talk Tickers hat for you, the retail investor.
Yeah, we are getting right into the weeds today.
Exactly. Our mission is to decode the Wall Street jargon from the Q4 and full year 2025 earnings call for Hubbell Incorporated. Ticker symbol HUBB.
Such a fascinating company to look at right now.
It really is. We want to dig into their actual, underlying performance and figure out exactly what this data means for your portfolio.
Right, because corporate earnings calls can be, they're kind of like a magician's act.
Oh, that is the perfect analogy.
Right. I mean, management always wants you to look at the flashy hand, the big shiny top line numbers.
But over here, everything's great.
Exactly.
Yeah.
But we are here to look at what is hidden in the other hand.
So to do that, we are keeping the vibe data forward. We're using plain language, and we want this to be highly actionable.
Love it. Let's start with the big reveal, the headline numbers.
Yeah, let's fire off the top line Q4 metrics. So net sales hit $1.493 billion.
Which is a very solid 12% increase year over year.
Definitely. And adjusted diluted earnings per share, the EPS, that came in at $4.73.
So that's a 15% bump?
Right. But okay, let's unpack this for a second because there is a discrepancy here if you look closely.
Oh, the margin magic.
Yes. Sales grew by 12%, right? But adjusted operating profit grew by 19%, landing at $349 million.
Yeah, that is the standout metric.
How do you make more profit on proportionally fewer sales when you're literally dealing with heavy raw materials?
Well, this is the holy grail for an industrial manufacturer. It's margin expansion.
Okay, break that down for us.
So in Q4, Hubbell expanded their adjusted operating margins by 140 basis points.
Wow.
Right. So across $1.5 billion in sales, their profit margin got 1.4% wider.
Which, in heavy manufacturing, with copper and steel being so expensive, finding an extra 1.4% is huge.
It means someone is running a phenomenally tight ship. Management calls this price-cost productivity.
Right, the classic corporate jargon.
Exactly. It just means they raised their prices to cover inflation, but they also slashed internal production costs.
So they didn't just sell more stuff, they actually got way more efficient at making it.
Yeah, and that efficiency translates directly into cash. Free cash flow for Q4 was $389 million.
Which is a massive war chest.
It is. They finished 2025 sitting on $875 million in total free cash flow. That's a 15% margin.
That's incredible. And reading the sources, they converted, 90% of their adjusted net income straight into cash?
Yeah, 90%.
I always feel like that conversion rate is the ultimate lie detector test for an earnings report.
Oh, absolutely.
Because, sometimes a company claims massive profits, but it's just unsold inventory sitting in a warehouse somewhere.
Or clever depreciation math.
Right. But a 90% conversion means the money actually hit the bank account.
And you don't generate nearly $1 billion in free cash flow with accounting tricks. You need a massive tailwind.
And what's fascinating here is that Hubbell is riding two massive secular trends.
A true tale of two halves. Let's look at the first half, utility solutions.
The physical power grid.
Exactly. This segment pulled in $936 million, up 10%. And grid infrastructure specifically grew 12% organically.
So why the surge? Utilities are essentially being forced to open their checkbooks right now, aren't they?
It's a two-front war for them. First, they have to physically connect completely new load sources to the grid.
Like those massive wind farms in the Midwest.
Wind farms, huge solar fields in the Southwest, giant new manufacturing plants. The legacy grid wasn't designed for this bidirectional power flow.
Right, it's too decentralized now.
Exactly. And the second front is just basic resiliency. The wooden poles, the neighborhood transformers, they're aging rapidly.
Plus the severe weather events keep knocking them out.
Yeah. So utilities are aggressively upgrading transmission lines and substations just to keep the lights on.
But wait, I do want to pump the brakes here for a second and offer a balanced view.
Okay, let's hear it.
Because it wasn't a perfectly smooth trajectory. There was a pretty glaring weak spot.
You're looking at grid automation.
Yeah, grid automation sales actually declined by 8%.
That's right.
Management pointed the finger directly at their Aclara metering business. So translate this for us. What happened there?
It's a classic case of trying to do too much. Aclara was great at serving smaller municipalities and co-ops.
Like local, straightforward, smart meters.
Right. But Hubbell made a big bet. They tried to pivot and win these massive enterprise contracts with investor-owned utilities.
Big IOUs.
Yeah, the giants that control entire states.
Which, sounds logical. Go catch the biggest fish.
On paper, sure. But the tech requirements for an IOU are just light years beyond what a local co-op needs.
Like what kind of requirements?
Insanely complex proprietary mesh networking protocols. They need to handle millions of data points, and the regulatory hurdles are suffocating.
Oh, because they cross state lines.
Exactly. Plus, integrating into their legacy billing software is a nightmare. The adoption cycles are agonizingly slow.
So the massive projects they banked on just fell through or got delayed.
Pretty much. So now management is taking their medicine. They're retreating entirely from the IOU space.
Going back to the munis and co-ops.
Right. It's a painful contraction, which is why we saw that 8% drop, but it stops the bleeding.
Okay, that makes sense. So let's pivot to the other half of the business, electrical solutions.
This is where things get really wild.
Yeah, this segment generated $557 million, which is up 13% organically. But the jaw dropper,
The data centers.
yes, data center sales grew a staggering 60% in Q4.
And 40% for the full year.
We hear endlessly about the AI boom, but it's always about the microchips, right? Or the software.
Nobody talks about the wiring.
Exactly. But Hubbell is building the physical infrastructure required to pump unimaginable amounts of electricity into these buildings.
Without melting them down.
Right. And to prove this isn't just some macro fluke, we have to look at the Burndy brand anecdote from the transcript.
Oh, this is such a good manufacturing story.
So Burndy makes these heavy-duty copper electrical connectors called lugs.
Essential for securing huge cables without dangerous arcsing.
Right. And when data center demand exploded, Hubbell didn't just hire more guys to bend metal.
No, they invested in automation.
They poured capital into 4 highly specialized enclosed automation work cells.
They took a workflow that used to require 6 separate manual processes.
Like cutting, stamping, bending.
Yeah, all requiring people moving parts around the floor.
Yeah.
And they consolidated it into one automated line.
They reduced the processing time from days to literally minutes.
That is just incredible operational leverage.
I compare it to a fast food drive-thru.
Oh, okay. Let's hear the analogy.
So imagine a drive-thru with a single window, right? One person taking orders on a notepad.
Right, totally fine for the lunch rush.
Right. But suddenly, a fleet of 50 charter buses pulls up.
It breaks the system.
The kitchen catches fire. You can't just yell at the cashier to write faster. You have to shut down the bottleneck.
You install a fully automated dual-lane digital system.
Exactly. And then you process those buses seamlessly with higher margins than ever. That Burndy factory is the industrial equivalent.
And that is exactly how they drove a 19% profit increase on just 12% sales growth. Marginal labor costs dropped to 0.
Okay, so that's the story behind 2025. But let's look ahead. Management gave some really specific guidance for 2026.
The crystal ball.
Yeah, they're projecting 7 to 9% total sales growth and 5 to 7% organic growth.
And an EPS target of $19.15 to $19.85.
Which sounds robust, but I want to raise a direct concern for the retail investor here.
The inflation threat.
Yes. Management explicitly mentioned mid-single-digit cost inflation coming for raw materials like copper and steel in 2026.
That's the existential threat for anyone bending metal.
Right. Should you be worried that those beautiful profit margins are about to get eaten alive?
You'd think so, but management talked about this concept of wraparound price.
Okay, translate that jargon for us, wraparound price.
Well, Hubbell pushed through some serious price hikes in Q4 of 2025.
So the hard part, the painful negotiations, is already done.
Exactly. And now those higher prices will carry over or wrap around into the entirety of 2026.
Sort of like an annual software subscription.
Exactly like that.
If a streaming service raises their fee in November, their total revenue for that year barely moves.
Because it was only active for 2 months.
Right. But the next year, that higher price applies to all 12 months. It wraps around.
It creates a massive baked-in revenue boost. So between that wraparound pricing and another $15 to $20 million, they're investing in restructuring like.
Replicating those Burndy automated cells.
Yeah, management isn't just neutralizing inflation. They actually expect another 50 basis points of margin expansion.
That requires immense pricing power. If your product is easily replaceable, you can't just force a Q4 price hike without losing customers.
It shows how sticky their components really are.
But, okay, I have to play devil's advocate on another piece of the 2026 guidance.
Go for it.
We were just hyping up this 60% data center growth.
Yeah, massive numbers.
But management guided data center growth to just the mid-teens for 2026.
It's a huge deceleration.
Is the AI hardware bubble bursting? What's going on?
I get why that triggers alarm bells, but we need to connect this to the bigger picture. It's all about their project load.
Project load, okay.
Yeah, in 2025, Hubbell shipped an unprecedented volume of modular power distribution skids.
Let's quickly define a skid for the listener, because it sounds like a wooden pallet.
Oh, it's definitely not a pallet.
Right. It's basically a highly engineered, multi-million-dollar electrical substation built onto a heavy steel platform.
Yeah, it gets dropped into a data center by a crane to manage initial massive power loads.
So when you sell a bunch of those in one quarter, your year-over-year growth looks astronomical.
Exactly. You just can't comp 60% growth forever on physical products that massive. The factory capacity literally doesn't exist.
Got it. So the initial build-out phase is normalizing.
Right. Mid-teens growth on a newly expanded base is still highly attractive, especially because it's driven by short-cycle connector products.
The unglamorous consumables that data centers constantly need.
Exactly.
Now, there was another phrase the CEO used regarding their outlook. He called Hubbell a book and bill business rather than a book-to-bill business.
It sounds like identical accounting jargon.
Totally. Can you translate that?
Sure. A book-to-bill business is like a commercial aircraft manufacturer.
Or a defense contractor.
Right. They book a massive order today, giving them years of visibility, but they don't actually build it and send the bill for half a decade.
But Hubbell is book and bill.
Right. An order comes in and they manufacture and ship it almost immediately.
So they don't have this massive 5-year safety net of backlog.
They don't. But the advantage is that their order momentum is a real-time indicator.
Because they operate in the present tense.
Exactly. The strong Q4 order activity proves that demand for grid upgrades and AI power is immediate. It's happening right now.
Okay, let's pull all these threads together for the bottom line.
Time for the verdict.
We've synthesized the headline numbers, the operational story, the 2026 forecast. For the retail investor, what is the signal here?
Honestly, it's a highly bullish signal.
I agree, especially because of how insulated they are. Management admitted that heavy industrial and non-residential markets like office buildings are completely flat.
Yeah, they're sluggish.
But Hubbell is successfully surfing these two unstoppable megatrends: AI data centers and grid electrification.
The broader economy could stall, and utilities still have to upgrade substations.
Plus, the management team is absolutely ruthless about operational efficiency.
Days to minutes.
Exactly. And that discipline is projected to generate roughly $900 million to $1 billion in free cash flow for 2026.
Which gives them a massive war chest.
How are they going to use it?
Well, their first choice is high-return M&A. They recently acquired a company called DMC Power.
And that was a huge success, right?
Yeah, DMC makes specialized substation connectors that don't require welding. It saves a fortune on labor.
So they want to replicate that.
They do. But, and this is key, if targets are demanding ridiculous premiums, management signaled they will aggressively buy back their own stock.
Which puts a beautiful floor under the share price.
It's a huge safety net for the investor.
So if you hold the stock, the underlying fundamentals are incredibly sound.
And if you're considering it, it is a brilliant pick and shovel play.
Exactly. You don't have to guess which AI software is going to win the tech war.
Because whoever wins, they still have to plug into the physical power grid.
Which brings me to one final provocative thought I want to leave you with.
Oh, let's hear it.
We hear so much about the glamorous AI companies, the microchips, the software model.
Silicon Valley stars.
Right. But Hubbell sits quietly on both sides of the physical power equation.
They supply the grid infrastructure to bring the power to the site.
And they provide the electrical solutions to distribute it inside the data center. Right. So as the AI revolution demands exponentially more physical energy, ask yourself, are unglamorous nuts and bolts industrial companies actually the safest, most overlooked way to invest in our technological future?
It's a great question to mull over.
Definitely.
Yeah.
Keep doing your own research, dive into the filings, and stay curious. We'll catch you on the next deep dive.